Have you ever wondered how you can invest in hundreds of companies without buying hundreds of different stocks? The answer could be an ETF. ETF stands for Exchange Traded Fund. And while the name sounds complicated, the basic idea is actually very simple. Think of an ETF like a basket. Instead of buying one company's stock, you can buy one ETF that holds many different investments. For example, an ETF that tracks the S&P 500 can give investors exposure to many large US companies through a single investment. That means you don't have to research and purchase every company separately. One investment can give you diversification across many businesses. So why does diversification matter? Imagine putting all your money into one company. If that company suddenly loses a large amount of value, your entire investment could be affected. But if your money is spread across hundreds of companies, one company's poor performance may have a much smaller impact on your overall portfolio. That's one reason ETFs are popular among long-term investors. Now, ETFs aren't all the same. Some ETFs track large US companies. Some focus on technology. Some invest in international companies. Some focus on bonds. And others concentrate on specific industries or investment strategies. So before buying an ETF, it's important to understand what the fund actually owns. Another important thing beginners should understand is the expense ratio. An expense ratio is the annual operating cost of a fund. For example, if an ETF has a 0.10% expense ratio, the fund charges approximately 0.10% of your invested money each year to cover its expenses. That might seem very small. But when you're investing for decades, even small fees can make a difference. That's why many long-term investors pay attention to low-cost ETFs. Now let's talk about one of the biggest mistakes beginners make. They think investing is about getting rich quickly. It isn't. Markets can rise, and markets can fall. Sometimes prices can drop dramatically. That's normal market behavior. The goal of long-term investing isn't to predict every move. It's to build a strategy that matches your goals and stick with it. Another important point: don't invest money you need for your everyday expenses. Before investing, consider building an emergency fund and taking care of high-interest debt. Investing works best when you can leave your money invested for the long term. So, how can a beginner start learning about ETFs? Start by researching what the ETF holds. Look at its expense ratio. Understand what index or strategy it follows. And consider how it fits into your overall financial goals. Don't buy an ETF simply because someone on social media says it's the next big thing. Do your research first. And remember, past performance doesn't guarantee future results. ETFs can lose money. There are no guaranteed returns. But when used thoughtfully, they can be a powerful tool for building a diversified investment portfolio. And that's the key idea to remember. You don't need hundreds of individual investments to achieve diversification. Sometimes, one ETF can give you exposure to a large group of investments. In Part 2, we'll look at how beginners can actually approach ETF investing. How much they might invest, what mistakes to avoid, and how long-term investors think about market ups and downs. Subscribe to the Money Code for more simple investing and personal finance videos.